Welcome back, guys. So the stock market lately is presenting a lot of difficulties for investors, but a lot of opportunities for those that know where to look. So recently I've announced on Instagram that I've started buying up stocks, and I want to show you my portfolio up to date. This will be a 24-month portfolio. I'm going to be scaling in as I go, and it's just something that I'm doing on the side, guys. But that's not the purpose of this video. The purpose of this video is to actually go through the evaluation process that I go through to pick the right stocks. Because look, we are facing a difficult time in the stock market, uncertain time, where you have tapering interest hikes, you have the economy recovering and the rug being pulled under the economy. So now we're looking to see whether we're going to have a self-sufficient economy without the Feds and government intervention. So that's what the stock market is really worried about. Now, obviously, the market has dropped by 2%, just like it did in 2013. And I did inform you this could potentially happen in the last video. So with that being said, you got to make the decisions whether you're going to be investing, holding off, or you're just going to be doing your own thing. So I've started to scale in slowly. And I want to just show you how I pick stocks, because when things rebound, not every stock is going to rebound, guys. So you're going to have to pick the right stocks. And when the stock market takes a nosedive, because we are facing uncertain times, you need to be getting in with the correct stocks, that even if they drop, they won't drop by much. But I'll explain it to you guys. So let's jump right in, smashy, and let's go through the evaluation stage, and let me show you guys the stocks that I'm holding currently. So here is a little screenshot I took from my portfolio. So we have a few stocks: Activision, Citi, Colgate, Delta Airlines, General Motors, PayPal, Plug Power, Restaurant Brands, Visa, and Zix. These are a couple of stocks that I'm holding. I invested a lot of money here, but I'm going to be adding, and this only represents 20% of the total cash that I'm willing to pump into the stock market in the next couple of weeks. And when I say scale in, I mean I'm going to be buying every week different shares, or add extra cash into each stock at different prices, because there is a lot of uncertainty, especially the Fed's decision to taper interest hikes. So that will affect certain stocks. Interest hikes will hit a lot of growth stocks that are running under debt, and interest hikes will benefit a lot of bank stocks. So here is the evaluation stage, and it really all leads back to risk level. And the way I do this, and this is what I usually do, you would have this Excel sheet. It's a watch list. Put in your tickers that you're interested in, the current price, the industry. For example, let's say the current price is 51 for General Motors, the industry, automotives, in short, cars. Okay. Ideal price you want to buy it at, well, let's say you want to buy it at 50. All right, that's the price you're willing to pay for General Motors. Risk level. Now that's what we need to identify, and that's what building up a portfolio is all about, is identifying risk level, guys. You need to have different levels of risk in a portfolio, and the way we identify risk is based on, well, how's the company doing? Is this a worthwhile company? Is this a company that could drop significantly if the market drops? And I'm going to show you how to do that. So let's pick a stock. For example, let's pick the first one, and this broker that I have actually does the risk level for me. For example, here, this is A, this is B, this is D, right? As we go into emerging markets, the risk level increases. So Plug Power is an emerging market because it's hydrogen and clean energy. So let's just pick one of those stocks that I'm holding. Activision, for example. Okay, Activision Blizzard. A lot of you are familiar with this stock because a lot of you play Call of Duty in games. So you come to Yahoo Finance, and forget the chart for a minute, even though this chart looks really good because we came from the highs. So if you're a value investor, you need to see a stock that has dropped from the highs. But you need to understand why that happened. And again, that happened because there was an announcement of tapering. So you see the stock market reacted to that in the summertime. So let's go to statistics. First thing we do, statistics. I want to see Number one, is this company being backed by big money, right? i.e. institutions. So let's go to share statistics and let's go to percentage held by institutions. We have 89% of institutions holding this. That means hedge funds. Now, the reason why I'm looking at this is because historically speaking, hedge funds don't sell as fast as retail traders when something happens. Matter of fact, they get to add more shares to their positions rather than sell positions. So let's say the stock market gets freaked out, for example. 89% is being held by institutions, funds, into their growth portfolios. So if the stock market, especially in uncertain times, decides to come out with some news, this stock won't drop as much, because it has stable money, unlike retailers where they get scared easily. So with that being said, that's identified. The rule of thumb is I'll only invest in something that has at least 70% and above institutional holding. Now, this is perfect for you guys who are not willing to take as much of a risk, because we don't want manipulation in that stock for long term. Let's just do it the old school way. Now, we go to cash flow statement. Remember, this is under the tab statistics. I want to look at operating cash flow, TTM. That's before debt obligation is paid, by the way. Then we look at levered free cash flow. That's after debt is paid and all the financial obligations are paid for a company. So that's what we look at, levered free cash flow, 2.38 billion. What that means is this company has money to spend on development or dividends and pay dividends out, etc. So that just means this company is profitable. Now, let's see if this company's grown financially year after year, because that's what's going to cause this stock to actually show growth. Let's go to financials. 2017, it started growing. 2018 it grew by 500,000. Obviously, that's in millions, guys. It's not thousands. 2019 it dropped, and you will see that's reflected on their stock. 2020 they gained significantly, and yes, that's reflected on their stock. Now, obviously, we don't just look at revenue because that's after costs. So we look at earning per share growth. That's how much they earn per share they have issued to the public. So yes, it's grown significantly in 2020, and we can see that it's all-time high because of that. So your decision is, will this company come out to make more games and whatnot in the future? That's the decision you have to make. And that's it. That's how you evaluate, guys. So now you just put it here into your risk level. How risky it is? Well, 90% of institutionals are holding this. That means if it does end up dropping, it won't really drop that much. Now, this is an unorthodox way of doing things. So you can say medium level, okay? Especially given the fact that, it's one of those stocks that develops things on quarterly basis, not every day. It's not a consumer staple stock. So you can say medium risk. And that's essentially, guys, how you analyze a stock. For a retailer, we don't have the tools hedge funds have. And we come to holders. I want to see what big names are holding this stock. Vanguard Group, BlackRock, Public Investment. These are two big funds. Vanguard Group, that is 10% of their holdings. Is Activision. BlackRock is same thing. Surely they know something I don't know. All right, these guys pay analysts thousands and millions at times combined to give them the right information. So obviously, if big money's backing it up, so will I. So with that being said, let's pick another stock, for example. Let's say a growing industry. So what this is, guys, is a diversified portfolio. What we have here, we have a growth stock. Okay, let me get the thing here. This is a growth stock. Growth. This here is a dividend stock, Citi Group. This will benefit from interest rates. Okay, so this will be growth. Citi Group will be dividend. It's a dividend stock. Colgate is a consumer staple stock. So Colgate is consumer staple. So what you need is, you need anchors in your portfolio to hold your portfolio down. Big tech, big names, big companies that are held by institutions. They act like the anchor. So when you have an anchor in your portfolio, big giants to hold your portfolio down, you can start taking risk and making risks in stocks like Plug Power, which is deep. I mean, Plug Power is emerging market. Okay, this is an emerging market. Emerging markets usually generates a lot of returns, more than an existing stock. For example, this here is a new company, so we can call this also emerging for now. And this here, Visa, we call this the anchor, right? So Visa actually makes up about 30% of my portfolio, because this is the anchor of the portfolio, alongside Activision, Colgate, PayPal Holdings, and Visa. So this is how we divide the diversified portfolio, and there's nothing else you can do other than that. Okay, you don't have the same tools as everybody else. I mean, you can look at the revenue growth, you can look at the cost of revenue, is it dropping the costs, or do they keep increasing their costs? That means there's something wrong. But now every stock is taking a hit, because investors know when interests are hiked, a lot of stocks will suffer from that. But again, we had interest hikes throughout history, guys. Looking at history, 2013 and so, the market took a plunge by 2%, but ended up recovering when the economy became self-sufficient again. So that's how I analyze and pick my stocks. And again, there isn't much you can do other than mini analysis. As a hedge fund kind of investor, that mentality, you need to diversify. And you need to just understand the use case for a company. Is there going to be a use case or a case study in the next, let's say, 12 to 24 months? Will this company, product, service still be relevant? Not the pandemic, after the pandemic. That's what we want. We want after the rug is pulled, after everybody goes back to normal. And if it doesn't, well, is it still going to be useful even if things don't go back to normal? That is the decision you guys have to make at this stage in your life. That's me done. I gotta go. I'll be scaling in slowly into this portfolio as I go, guys, as well as just day trading on the side. This is just something I do. So I'll be adding in. This is a 12-month to 24-month portfolio that's gonna last, as much. So it's gonna get bad before it get worse. I want you to know this. So I'll be red before I'm green. And that's just because we're heading into uncertain times. And that's why I've only put in 20% of my portfolio, or of the capital that I'm willing to risk in now. But I'll still add more as I go. I'm done. I'll see you next time. Don't forget to smash that like button if you learned something new. And peace and love, just like always.